Okay, welcome to an episode of Make Money Count. We have been away for a little while. We took the month of December off. Many of you have noticed, so thank you. I shouldn't keep saying we because the chair next to me is vacant. Justin's not here today. But I am in our new studio, which looks a lot like our old studio did. And we are ready to get started. So there's so many things to talk about. I want to give a quick overview of where we're at right now with the Canadian economy. It feels like anything economic is always a bit of a balance, and we're entering into a new balancing act, if you will. And I think it's going to be one that requires the Bank of Canada and the Government of Canada to work in concert together. And I think that we are well positioned to do that, considering our Prime Minister now was the Governor of the Bank of Canada in the past. Let's address the elephant in the room first, though. A couple of days ago, the United States, under the leadership of their very interesting president, decided to go into Venezuela, a sovereign country, and kidnap, take, arrest the leader of that sovereign nation at nighttime and his wife, and bring them back to the United States to face charges. And it sets a very interesting precedent, I think, for other countries around the world. I think it does kind of two things. I think, number one, it's got Greenland, Cuba, and Colombia extremely worried. I think it's got, and Mexico, from a perspective of protecting their sovereignty. And I think that we in Canada should be a little bit concerned that Venezuela's oil is going to come back online. And I've read so many articles about it that tell you that it's going to cost too much money to bring the oil back online. It's going to take so many years to bring the oil back online. I think that if there's one thing that this administration's kind of taught us about themselves, is that they're not afraid to make extremely bold actions in order to get a result that they're looking for, and one that, this president can be praised for well into the future. So I think that, it's certainly a wake-up call for Canada. For those of you that aren't that familiar with the Venezuela situation, or you haven't read voraciously about it recently like I have, I can just tell you that the type of oil that comes out of the ground, the heavy crude that comes out of the ground in Venezuela, of which there is lots of it, by some estimations more than anywhere else in the world, is the same type of crude that comes out of Alberta. And we have one pipeline that sends our Alberta oil at a discount down to refineries that are in Texas. And those refineries are built for this type of oil, but they were built for the oil from Venezuela. And Venezuela's production of oil went down to less than 1 million barrels a day. And it's a country that is capable of producing 5 million barrels a day. And the daily supply of oil is about 100 million barrels a day. So adding 4% to that is definitely going to have an impact on oil prices. I used to do this thing on CP24. Maybe we'll show a clip of it. But I used to do this thing on CP24 where I used to go there every Friday, and I used to talk about what happened during the week in economics or in the market, and how that was going to affect your mortgage. So I'm going to try my hand at doing this for Venezuela. And you have to think about this as like all things in a vacuum, right? So obviously we've got a few other things going on in our economy right now with, inflation, GDP, labor, consumer confidence, but all things in a vacuum, assuming we had no other things going on in our economy right now. How would the capture of Nicolas Maduro and the plan for the United States government to go in and essentially nationalize oil production in Venezuela for themselves? I know that sounds crude, and it is a crude way of explaining it. Eventually what's going to happen is the United States is going to go in, or they've already gone in, but they're going to take over that oil industry with their oil companies. It's going to take hundreds of billions of dollars worth of investments, and those oil companies will need assurances that those investments that are being made will not once again be lost by another nationalization that takes place in Venezuela. So Trump's going to have to give those oil majors a level of confidence. But once that happens, because I believe that it will happen, like there's no doubt in my mind that that's the path this is going to. Once that happens, how does that affect Canada? How does it affect your mortgage? So I think there's two things. I think number one, Canada's economy would take a hit because we are no longer producing that oil and sending it to the United States. And if we don't do something about it, read pipeline out to the west to trade our oil with other nations. I mean, the no-brainer here is we need a refinery. We need a refinery that can refine that oil ourselves so we can sell it on the open market at the price that oil trades for, not at some discount because we aren't capable of refining oil in our own country. You're going to hear more and more about that in the news. But if we don't do that, this will be a negative hit to the economy. And short term, I think it will be a negative hit to the economy, medium term. And as a result, I think what you're going to see is bond yields drop further, meaning fixed rate, downward pressure on fixed rates. You could see another 25 basis point drop from the Bank of Canada. I think you might see that anyways. I know that's not a popular opinion right now, just based on what the central banker is Tiff Macklin's telling us. But I do think that generally speaking, medium term, if we don't do something about it, this is going to be a hit to our GDP. It's going to be a hit to the Canadian economy. As a result, we're going to see bond yields trickle lower. Simultaneously, it'll be good news for inflation because the price of oil will drop. Therefore, gas prices will drop. So less of your wallet will go towards filling up your massive Ford F-150 or whatever car that you have. So that would be my CP24 like mortgage minute from the TSX, I think we called it, or something like that. Generally speaking, okay, so the elephant in the room is gone now, Maduro, I guess literally and figuratively. Generally speaking, we've seen some activity in bond yields over the last 30 days. Well, we haven't been talking together. So Sandu, if you can pull up the bond yields chart for me, that would be great. Over the holidays, I realized just how much YouTube I watch on my TV as opposed to on my phone. Anyways, so bond yields have gone up. Bond yields have gone up like 30 basis points. They were up 40 basis points over the last 3 months at a certain point, and they've started to come off a little bit, but they're sticking between that kind of 3% to 2.9% on the 5-year Government of Canada bond. Now, that's important. That is, remember, 5-year bond yield is kind of like our barometer, right? It takes all of the information that we talk about. It takes, the CPI number from November 15th, of which we're going to get a new one, which we're going to get a new one out shortly for December. It takes the CPI number. It takes the GDP number, which came in lower than what we were expecting. It's going to take the employment number that's coming in soon that we're expecting next week. It's going to take U.S. numbers. It takes all of these numbers, and traders then assign probabilities to where interest rates are and where they're going to go. And as a result, we end up with the bond yields. So when you see bond yields up like this, it's a result of a few factors. The main factor is Tiff Macklin and the Bank of Canada, when in their last meeting, came out and said, we believe that the overnight rate is at a not too stimulative threshold, and we believe that there's not really much more we should be doing to manipulate the overnight rate, drop it, to help the economy. And what that is telegraphing, and what the bond market is telling us now, is that the governor of the Bank of Canada is kind of pushing the agenda over to the Prime Minister, and he's saying monetary policy, which is the ability to increase and decrease interest rates by the central bank, needs to now be complemented with fiscal policy, which is the government's ability to spend. And we saw some of that in the budget that was released by the Liberals, although it seems to me that it's a little slower. It's a little slower moving than was initially anticipated. I can tell you we've got some exposure to the housing file within the bank or the government of Canada's new budget. And, they're kind of shrinking now and eliminating the affordable housing fund within CMHC. And they're creating a new entity called Build Canada Homes. I think that's great. I just think that the issue that's being created in any of these budgetary decisions that have been made is that creating these new entities or creating these new projects, governments move slowly, and it takes time for that capital to trickle through to the economy. And the faster it gets there, the better it is in these situations. And by creating new entities, it slows down that process, right? And listen, the Prime Minister of Canada is trying to do things that really haven't been done for at least 10 years, 15 years. And he's trying to do things in order to strengthen the economy and put it on a better footing going forward. A lot of that probably requires a little bit of time. The problem is, how much time does the Canadian economy have right now? So we didn't dip into a recession, but employment numbers are falling, and we may have inflation under a little bit more control. Let's just pull up the CPI number from November here. So, you can see, like, in 2022, we were at a 8% inflationary number. Things felt really, really weird. We came off of that. We thought that inflation was just going to be transitory. We absolutely destroyed Canadians with high interest rates. We have decimated the housing market. We have changed the balance in kind of like the whole condo world is destroyed. We've got a whole bunch of purpose-built rentals coming in that's putting downward pressure on rents. But into the future, we're not producing anything. So, listen, rates have seriously affected the Canadian consumer. Couple that with tariffs that have come in that will really continue to hurt southwestern Ontario and Quebec. And you're going to see unemployment numbers continue to rise. And I think that going into January and February of this year, let's say the first quarter of this year, the real balances that I kind of started talking about will be between the central bank and the federal government. So who's going to do what? And at a certain point, does the federal government say, we may need another rate cut? Like, do they kind of speak and decide that, listen, another rate cut might be required? Like, we may need to lower the overnight rate further. I do suspect that will happen at some point in 2026, because I think that the economy is far weaker than some of the numbers that we're reviewing from December of 2025 and November of 2025 indicate. I think that inflation will prove to be more under control. Food prices are killing Canadians right now. And I don't want to keep getting into that, but why do we have an oligopoly that runs food? Why do we have an oligopoly that runs banking? I honestly, let's not get into that right now. But all of this is to say that I think that we've got inflation somewhat under control now. I think that we could use another 25 basis point rate cut. I think we probably will see another 25 basis point rate cut. I think that we're going to see more stimulus from the federal government. Whether that's good or bad, I don't know. I think what we really need is some certainty with our trading partner to the south, and I think that's the last thing we're going to get. For everybody that is watching our first podcast back for January, I would say, to summarize, the ousting of Nicolas Maduro is terrifying if you are any country that is in Trump's line of vision. I think if you want to relate it back just to your mortgage and to the general economy in Canada, if we do something about it, if we create a refinery and a pipeline and start distributing oil other places at its market rate, this could be a huge win. But that does mean bond yields probably go up, but it also means the economy starts expanding, which would be amazing. Like that's a bright spot on the horizon there. Don't forget that. And it also probably, if all that Venezuelan oil comes online, it probably means cheaper to fill up. And then on a go-forward basis into 2026, I think we continue to look at the dynamic between the federal government and the Bank of Canada to see who's going to pitch in where. Hopefully some of that stimulus that's being injected into the economy by the federal government. I never thought I'd say a sentence like that. Hopefully about stimulus. But that is really what we need to prop up our economy right now because it sucks. But hopefully some of that stimulus that we're pushing into the economy reduces the burden on the Bank of Canada. I don't think so because I don't think it's going to hit where it needs to hit fast enough. And I think the economy needs another 25 basis points. That's just my opinion. Anyways, for my next opinion, you can tune in next week. Thanks. Maybe Justin will be here.